Hi, Adam Watson here from the JMRD Watson's Chatham office, coming to you on January 4th, 2023. And I thought I'd take a moment to film another video. This one will be maybe a little more slide heavy than some of the past ones, but we thought it prudent to go through a year in review for everyone, just to look at what transpired in 2022 and what that means for 2023. So just bear with me here, and I'm going to bring some slides up. So the let's start with what happened in 2022. So what were some notable events? And as hard as it is to believe, when we were reviewing last year's first market observer, Ontario was in COVID lockdown, school was delayed, it was a stay-at-home order and mandate. So we've come quite a far ways on that aspect. Following that in January, the Winter Olympics started, and at the same time, Russia was moving troops to the Ukraine border, and this would prove to be one of the more important events of the year. Within days of the Olympics closing, Russia invaded the Ukraine. So immediately, commodity prices skyrocketed. There was lots of concern in the markets. Europe wondered where they'd get their natural gas from. Wheat prices and beans jumped as well, and this led to a big change in government policy or Bank of Canada and Federal Reserve policy, as even early into 2022, they still deemed inflation to be transitory or temporary, for the year. But after the spike in commodity prices, that was no longer the case, and inflation and squashing inflation became a going concern for governments around the world. Um, and this led to, by the end of the year, interest rates rising very drastically in many countries. So in Canada and the US specifically, rates rose faster than they ever had before, in a shorter time period. So we had rates increase over 4% in like a 8 or 9 month window, where normally a 4% rate increase can take 18 months to longer. A few other notable events. Rogers had their outage where everything was shut down, ATM terminals. The weekend's concert in Toronto was canceled. Queen Elizabeth passed away. The World Cup was won by Argentina, and maybe next most important, towards the end of the year, China began to reduce their COVID protocols and restrictions. So what does that mean over the course of the year? Stock markets were bad with interest rates going up. Bond markets didn't perform much better either. So 2022 turned out to be the third worst year ever for a 60/40 or balanced portfolio. So a balanced portfolio would be our most common mandate between no risk and full risk, or income and maximum growth, and the returns were comparable to basically the Great Depression, and even worse than the financial crisis, which most remember from about 15 years ago. So specifically, bonds were a problem, or fixed income investments were a problem in 2022, and kind of in a big way. So you can see over the last 45 years, bonds have been down 5 times. 2021 and 2022 are the most recent examples, and it's kind of astounding to see how far bonds went down in 2022, even compared to prior losses. So why does that matter for a balanced portfolio? Well, it was an off. Usually, as you can see from this chart, ideally we'd be in the top right corner, where bonds go up, stocks go up, and everything is good. If you look, typically when U.S. stocks fall, which is the bottom axis, bonds go up, and conversely, when bonds go down, usually stocks go up. So there's been very few instances where both have gone negative in the same time, and 2022 is very much an outlier. And this, there's a lot of numbers on this slide, but it kind of rehashes the last slide in number form. So going back nearly 95 years, there have been 5 instances where stocks and bonds have been negative at the same time, and like the slide from 2 or 3 before, the bonds had done significantly worse in 2022 than in any years past. But the good news is typically after both went negative, usually there's a recovery year not far after. So a conversation I've been having a lot is why or how can bonds go down? And bonds are priced every day like stocks, but unlike stocks, there's a few other factors than just buyers and sellers in the market. And to oversimplify things, you should think about bond prices like a teeter-totter. So when rates go up, in the example here, bond prices fall, and the reason for that is people want to earn the same return they could on an old bond that's already been issued as they could on a brand new bond coming out today. So nobody wants to buy a bond issued 5 or 6 years ago at 2% per year if today they can buy one at 5 or 6 or 7. And the opposite is also true. If interest rates fall, like most of what we've seen over the last 15, 16 years, then bond prices go up. So you kind of get the double move of, you get your interest rate and then you get some growth, at least until it gets closer to maturity, because as we know, bonds are usually issued at par and they mature at par. So what happens in the middle is noise, essentially, and only matters if you need to sell on that specific day. As bond prices fall, that does provide an opportunity to change some of your return from interest, which is the worst taxable income outside of working income in Canada, and move it to capital gains, which is a little more tax advantageous, as you'll pay the tax man less. So let's show an example. What does it mean when interest rates go up, bond prices go down? So in this hypothetical example, the bond's paying 5% interest, and if bond rates move up 1%, a 2-year bond will fall about 1%, a 10-year almost 7, and a 30-year about 13.7%. A 2-year, similar example, but the drop in bond price is more significant. A 3-year, more significant again. And unfortunately, this chart doesn't show a 4 to 4.5% rate increase like we saw last year, but it proves its point. And that's not actually what happened. It's just an example of what can happen, or what is expected to happen to bond prices as interest rates move. So that brings up the next question of, how often do bond prices move? Bond prices move a little bit every single day. They trade in a market. It's not as transparent as the stock market. Lots of times it involves one desk calling another desk and finding out if they have a bond available to buy or sell. But as you can see, in most years for the last, we're back out to almost 50 years, bonds have finished the year positive. However, they still have fallen over the course of the year, and the average decline in any given year is about 3.3%. So 2022 is a drastic outlier compared to that average over the last 47 years. Bonds were positive in 42 of the 47 previous years. The caveat I'll give is that for most of that time, as some remember, rates were very high in the late 70s and early 80s, and they worked their way to essentially zero for most of the last decade. So this doesn't show a prolonged period of increased rates in the chart. Now, let's compare that to the stock market, because a balanced portfolio, or our most common portfolio, is still more in the market than in the stock market than in the fixed income market. And you can see that the average returns are more volatile. So this chart only goes back 42 years versus 47, and the stock market has been up about 32 of those 42 years. So it's on average, the market's up about 70% of the time. And in any given year, the average drop in the stock market has been about 14% per year. So even though the returns on the market over this 42 years have averaged about 9.5%, there has been a fall of about 14%. So if I compare that to the last slide on bonds, where the average declines 3.3, I did not mention that over this 47-year time period, the average bond return had been about 6.5%, but it did fall that 3.3% per year on average. So in 2022, we had big drawdowns on the stock side, big on the bond. Neither are finished the year at the bottom, which is nice, but still well down, and well outside the normal average range. What does that mean for 2023? The short answer is who knows. Lots of economists and advisors and brokerage firms will make their predictions this year, and I'll say almost overwhelmingly across the board they were wrong last year. It's a best guess, and we don't know what'll happen from today till the end of the year that will affect the outcome of the various markets. But one notable thing, if we look back 95 years, that balanced portfolio, which is our overwhelmingly largest sleeve, is down about 22% of the time over the past 90 years. And if you remove kind of the Great Depression years where things were really bad, the instances where a balanced portfolio was down 2 years in a row are very few. So there's basically 3 or 4 instances outside of the Great Depression, and typically after a big drop in a balanced portfolio like 2022, the next year historically has been quite good. So there are reasons to be positive. Focusing on the market, and this is most of my statistics were US based because it's significantly followed and analyzed more than Canada, because Canada is a much smaller market. But if we look at the Toronto Stock Exchange from 1956 to this charts to 2001, there'd been 18 negative years. So now we'll add one more for 2022. And the number of instances where the market had been down 2 years in a row was 2. So only 11% of the time was the market down 2 years in a row. If we look 3 years, it's 0, 4, and 5, it's also 0. So once again, a little bit of a reason to be optimistic going forward, just as a reversion to average. So as we go from a really bad year, if we're going to get back to historical averages, a better year is typically in store, whether that's a balanced portfolio, bonds, or the stock market. And a down year does provide opportunities to take advantage. To finish a little lighter for this segment and year in review, I've chatted about my reading in most of the videos. So I discovered audiobooks for this past year, plus physical traditional books as well. I completed 15 books. The most recent was The Greatest Comeback by John U. Bacon. So detailing the Summit series between Canada and the USSR. This is the biggest collection of interviews to put the story together ever on the Summit series, and arguably will be the greatest or the biggest collection as the participants all get older. And this book was released for the 50th anniversary of that series. So I was not around to witness the series, but I know how important it was for Canadian culture, and where were you when this happened? Paul Henderson goal finished the series. So that's kind of the list that I had for last year. I'm a better book starter than finisher, but hopefully I'll have that many or more to share with you next year. And let me know if you have any suggestions for reading. I always like to diversify a little bit. There's a few more names in there than there would have been in years past, or styles of book. And the entire team, as on behalf of the entire team, I just want to take a second to wish you all the best in 2023. So thank you for listening, and don't be afraid to reach out to any member of the team with any questions, to review your risk, and don't forget to follow the team on the Weekly Market Observer email, Facebook, LinkedIn, and Twitter for any of our latest up-to-date pieces. Thanks. Take care.